Hello, hi, Jerry Miller from Trendsignal here. Um, this is our weekly look at events that take our interest. One of the important ones for us, certainly here in the UK, is this autumn statement, and we're going to look at Thanksgiving holiday and some other topics as well. Just want to start with the autumn statement. Um, well, gloomy. It was gloomy. Gloomy certainly for the anyone here in the UK. Just for the record, Jeremy Hunt delivered something called his autumn statement. It's not a budget per se, but it almost felt like it. Certainly, it was designed to correct some of the problems that were caused by the trust and quasi-Kwarteng massive tax giveaway, unfunded tax giveaway, where they didn't consult really anyone about it. The debt office, the city, or indeed the OBR, the Office for Budget Responsibility. So it has been left for Sunak and his new administration with Jeremy Hunt in position as the UK Chancellor. He's basically put through 55 billion pounds worth of spending cuts and tax rises, a mixture of the here and now and the future tax rises. He's done that in a reasonably clever way or sensible way, you could say, by freezing tax bands, freezing inheritance tax bands, which creates something called fiscal drag, which effectively brings more and more taxpayers into higher brackets, so they pay more tax from one year to the next. And this is especially um, obvious with such high inflation. You're going to get more and more taxpayers brought into the higher rate tax bands. Hence, the tax rate will effectively increase from year to year. And that's one of the ways he's got of filling this 55 billion hole that was needed. Anyway, the good news is that the IMF thought it was a well balanced budget or statement and that it should do the job. The Debt Management Office, which is responsible for raising money for the UK Treasury by selling gilts so that they don't have to sell the 194 billion, which is what they were going to have to do with the trust quasi-Kwarteng debacle. That's now been reduced to 170 billion. That's the expectation, at least. And it's less than the 185 billion that most investors were expecting. So one of the positive things is yields. This is the thing that affects all of us. What we all pay for our mortgages, what we pay for our loans, for cars, etc. They're sort of benchmarked, as it were, against UK gilt yields. So let's just have a quick look at those. Hang on a second. So this is a chart of UK gilt yields from the Financial Times. Very good, paid for service, but it's well worth it. Just looking at the 10-year yield, currently at 3.21%. What does that all mean? Well, what it means is yields have climbed this year. It's been a big problem for investors with equities falling and yields on bonds rising, which is not the normal case. But it really was thrown into complete chaos when Kwasi Kwarteng announced his 45 billion pounds worth of unfunded tax cuts, because it effectively meant that a lot more gilts would have to be issued, and it really put the pension industry uh, completely at sixes and sevens. In fact, it was almost described as a crisis. The Bank of England had to intervene to prop up the gilt yields by buying gilts. Anyway, that's sort of past now. As you can see, the yields at 3.21. What was it when Kwarteng was dishing out his free tax cuts? Ran up to about 5%. It settled around 4.5%, whilst um, the Tory party and the public decided that it wasn't going to work. Anyway, uh, Jeremy Hunt replaced Kwasi Kwarteng, and then Rishi Sunak then eventually replaced Liz Truss. So the cities accepted it. International investors are happy with it. As I said, the IMF is comfortable with it. The debt management office is happy with it. But it is us, UK taxpayers, consumers, who are going to be paying for it now and in many, many years to come. And when I sort of say gloomy, it is sort of gloomy in a way. It's, we're entering winter, it's cold, we've got increase in energy prices and more to come. It just adds to the gloom, really. And it's not just the gloom generally, but gloom certainly within the Tory party, who it sort of goes against the grain, really, of what they're about. But you know, we can't afford things as a country. We have to pay for them, and this is the only way to do it. So there's no way out unless we improve productivity. So there you go. Let's get back to the presentation. So all of that was last week. This week we have an interesting week. You will all know, I'm sure, that it's Thanksgiving this Thursday. Gosh, we've had Black Friday adverts going on and on since sort of mid-late October. It used to be just one day, then it became a week, and then it's became a month. And let's face it, it's not even our Black Friday. It's nothing to do with us. It's the sort of major shopping day after that secular holiday, Thanksgiving in the US. So Thanksgiving, what's that all about? Well, the biggest focus for us as traders and investors is that it does mean that the markets are shut. It does mean that liquidity tends to dry up a little bit in the day beforehand as well. So Wednesday afternoon, evening is likely to be quiet in the US markets. All markets are closed on Thursday in the US. Some of the electronic ones stay open, but the liquidity participants are very, very thin on the ground because they're all on holiday. Friday, the markets, well, certainly the major equity markets, they'll shut early as well at 1 p.m. Eastern time, which is 6 p.m. our time. So it's a shortened day. It's a bit like what happens with our markets on Christmas Eve and New Year's Eve. We have a half day shutting at 1. Markets tend to be quieter, but actually, if you have an event and it's quite a significant event, you will find the moves will be a lot bigger. And the reason being is there isn't the sort of the liquidity there to soak it up. So it is a worthwhile week to be paying close attention to the markets for sure. Um, okay, next slide. Oil. Okay. Oil. Yeah, there's been a lot going on actually. Certainly, this is early Tuesday morning. I'm recording this. Yesterday in the oil markets, having had a very bad week last week, oil fell, gosh, close on 9%. Let's have a quick look at the chart actually. So this is a chart of UK oil, or Brent, other people may know it as. And as you can see, the market really spun off last week quite dramatically. And this actually sort of flies in the face of what actually is going on with the fundamentals. Well, I say the fundamentals, certainly following OPEC's surprise cut in production of 2 million barrels per day. That was sometime in October, early October. And that really annoyed the White House. It annoyed a lot of consumers because at a time when we're about to lose Russian oil or Russian products, certainly here in the EU. It just looked a bit like OPEC was taking Russia's side, I guess. Um, but oil has been struggling anyway. I think the rumours of this committee that was investigating ways to modify or soften the zero COVID policy of Xi Jinping have been giving equity markets a bit of a lift. It certainly helped oil markets as well. But more and more, certainly on Monday this week, there were more COVID infections in China, more rolling lockdowns, and I think it really started to depress the market as well. Coupled with that, there were rumours from the New York Times that OPEC was considering cutting production at its next, sorry, raising production. I apologize, raising production. So reversing some of the cuts that they made in their previous meeting. So they've got another meeting coming up in Vienna where the cartel meet. They're talking about perhaps up to 500,000 barrels per day. Anyway, Saudi Arabia came out and completely debunked that. And as you can see, this particular uh, candle here or bar here, we hit a month low, in fact, the lowest since January this year on oil. And then it immediately rallied as soon as Saudi Arabia basically denied that they would be discussing this. OPEC doesn't tend to discuss anything that it's going to discuss before the meeting. So it's all sort of shrouded in a little bit of mystery. We only hear about it afterwards. It doesn't seem logical with the oil prices falling that OPEC would be considering raising production by 500,000 barrels per day, because their stated aim was to manipulate the price higher, which is what cartels do at our cost. Anyway, there we are. I think global slowdown. some major economies going into recession. This is the reason why oil's sliding. It's also not hasn't been helped by the strong dollar. I know the dollar sort of weakened over the last 10 days, but it hasn't been helped by the strong dollar either. But I think the outlook for oil remains mixed to probably bearish. Probably the most um, determining factor is economic activity, and that really is starting to turn with recessions here in the UK, Germany, and other states in Europe, and with it likely that the US will go into recession next Q3, Q2, Q3 next year, depending on how the Fed manipulate interest rates. But I think they're going to have to raise rates to such an extent that inevitably it will push the US economy into a mild recession. Anyway, that's it. Thank you very much for listening.